Good afternoon and welcome. My name is Shelley Binder and I'm Development Director at the Workers Circle. Thank you for joining us today at our webinar on year-end financial planning. We have people zooming in from all over the US. Please take a second and post in the chat where you are calling from. At this time of the year, we are encouraged to step back and review our retirement, financial, or legacy plans. Today, two experts in the field, attorneys Jonathan Gudema and Stacy Suman, will be talking about recent changes in retirement and estate law, and will be giving us financial tips to put our minds at ease. Jonathan is an attorney, senior advisor at plangiving.com, and the principal of Plan Giving Advisors, LLC. Jonathan has 30 years of experience advising nonprofit organizations on estate planning and retirement gift options. Previously, Jonathan was a managing director at Changing Our World, the third largest US-based fundraising consulting firm. Jonathan has also held senior positions in plan giving at the ADL, United Jewish Communities, and Continuum Health Partners. Jonathan earned a BA in political science from Rutgers in 1990 and a JD from Western New England College School of Law in 1994. Stacy is the Chief Legal Officer and Managing Director of Plan Giving for the American Committee for the Weizmann Institute of Science. Previously, Stacy served as Associate Director and General Counsel for the Jewish Community Foundation of Metro West in New Jersey and is a past president of the Philanthropic Planning Group of Greater New York. Stacy teaches plan giving at New York's University's George H. Hayman Jr. Program for Philanthropy and Fundraising. Stacy received her JD from the University of Arizona College of Law and a BA from Bryn Mawr College. The program will be in the form of a conversation between the two experts, covering the latest rules regarding estate and tax planning and how these could affect you. There will be time for Q&A. Please post any questions in the chat, and Stacy and Jonathan will be happy to respond. Now, please join me in welcoming Stacy and Jonathan.
Okay, are we ready to go? Okay, great, both here. Okay, all right, I want to welcome everybody. Hi, my friend Stacy. I have a very unique career. I've been an attorney and what's called a plan giving professional, and Stacy is one of the few people who have literally like mirror careers. And so it's a pleasure to have recruited Stacy. I met Stacy many years ago with someone said, "Oh, try Stacy to have this conversation." So thank you, Stacy, for joining us. And I'll just tell you a funny story. Is that Stacy's been at Weizmann for how many years? 18 years.
March it'll be 18 years. Yeah.
So 18 years ago, Steve, your boss at the time, was recruiting me to join the staff. Do you know that? And he was recruiting very hard, and he made a really good offer. And the consulting firm I was at just outbid him, and he was so upset. And I next morning I said, try Stacy Suman. She's gonna be amazing. And I think a lot of people suggested you, and clearly that was a really good suggestion on their part. But okay, so we're gonna have some questions for each other, but please feel free to also ask questions during this, send them in the chat, and we'll try to read them out loud. And I'm gonna give a little overview of just the current situation. Quite often, the way the news pushes things out, things seem to be the heightened alert. Alerts, big changes. Yes, there was a big tax bill in the summer. And there are things that do impact you. I'll just mention a couple of the big things I don't think are really our issues. They stabilize the tax bracket. So this income tax brackets, now the maximum tax bracket is 37%. It was going to expire. And the irony is that while the news made a big deal of this, I'm not sure it would have been so I don't think it would have made a big difference to most people, the slight changes in the brackets. But okay, so that's a possible good thing for people. The tax brackets didn't change. The real effect of tax brackets is, it's ironically, it doesn't really very few people ever pay the highest tax bracket. It's graduated. So the fact that, let's say you were in the 37% bracket and it would go up to 39.6, it seems to be a big jump. But how much of your income would have been affected of that extra top percent? It would have been only the income above 500,000 of your AGI. It would have been really pretty high level. So that's been stabilized for now. By the way, there's no such thing. Would you agree with me, Stacy? There's no such thing as permanent tax law. No, this is it's always subject to.
Even if the word permanent is part of it, it doesn't mean anything.
Correct. Okay. So there are a lot of tax laws do expire. That has to do with the process of how they're passed, and they have to always match up, and this is the game that I've been following for about 25 years now. I watch, it doesn't matter which party is involved, they're always going through this game, and part of it will actually affect us today, which we'll talk about what they did with the charitable deduction. And so that's why you always have these expiring laws.
Right.
The president in power is, I've canceled the estate tax, but it expires. It expires and reverts back to a previous amount after 10 years. All right, so we have now the other big part. I'm not going to talk a lot about it, but I just want to mention very important to us. And those who are in New York and the higher state tax areas, they did adjust the state and local tax SALT tax limit. So back in 2018. There were a lot of changes. I gave a lot of speeches on the tax law changes back then. One of the big changes, which is not so positive for people like me, well, let's say my neighbors, or it depends on how much taxes you owe, particularly real estate tax, they capped your deduction on real estate tax or state level tax, state income tax and state real estate tax together at 10,000, which if your real estate tax is already above 10,000, you're losing significant deduction. So now they bumped it up to 40,000. Now again, that's not a permanent fix. They couldn't afford to give that. So for individuals who live in those states, when you do your tax returns, hopefully early in the year, you may see actually a significant difference. I have a neighbor of mine. His real estate taxes is around 40,000. So that's immediately an additional $30,000 deduction off his tax return. So I would say that's a positive for those, particularly New York, New Jersey, California, and the other states where you're particularly paying particularly high real estate taxes. And I'll just mention the estate tax, the new limits, the new lifetime exemption is 15 million per person, and which means that every individual has the ability to get on a federal level, be able to gift up to 15 million. Husband and wife get 30 million. They could do it during their life. They could do it during their estate. They could do it to individuals. Obviously, charitable bequests are not taxed, but the levels are very high, affecting very few people. And I think people, once anybody has in millions of assets, dollars, they really are going to be talking to attorneys anyway. I mean, they could join these programs, but the most likely people are able to avoid those estate taxes, but the levels are very high. Okay, so wait, one last thing. I did want to mention that both Stacy and I have connections to Workman Circle. So I do want to mention, because, all right, so Stacy, real quick again, you worked at
my grandparents met at Camp Huffnung. They were going, I guess, like the 30s or the 30s. They were teenagers. It's actually a little drama. They ended up eloping in Maryland. I don't really know what happened, but they were both counselors at Huffnung. They had gone there, and my mother was a counselor there a long time ago, and I grew up hearing all about it, hearing songs, stories. So it's been a very much part of my life.
Yeah, and I think I told you, I was my sister, my brother, and I were counselors at Camp Kindering, and my grandmother's second husband was a Workman Circle member. That's how he got us in to be working there. Okay, so thank you again, Stacy. All right, so Stacy, my question's for you, because I'm more split these days between consulting with nonprofits, but more working with individuals. Tell us about. I'd like to first start with the new non-itemizer deduction. Sort of, how does it work? How does it help individuals? And I can add to it, but I'll let you talk about that.
So again, thank you, Jonathan, for having me today. It's really an honor. I feel like my bubby is very happy up there knowing that I'm providing. She was a Yiddishist, and this is really an area, something that's always been very important to both my bubby and my Zeta, Alav Shalom. So one of the changes that is actually pretty significant in this and positive is allowing people to deduct for an individual $1,000 and for a couple $2,000 to deduct charitable gifts. It's called above the line because it's before you get to your, I guess, before you get to your adjusted gross income, you can deduct that from your income. And that is great for people who do not itemize, which by the way is 90% of the people filing taxes. I just went on ChatGPT and that's what so
You know where they got that from? They got that from my posts.
probably, all right.
I crunched the numbers from the IRS website. I came up
Okay.
with about 9% of tax filers itemize, and
Oh,
91 don't.
Yeah, so there you go. So there was a little version of this during the pandemic where you could do 300. I don't even think it went to 600 for couples. I think it was 300.
Well,
Tax-
yeah, first year was 300, and then the second is, well, we better to give it 600 for
Oh,
couples.
so it was 600. So this is actually a major impactful change to tax law. And because up until now, as we all know, but I don't think people even realize it so much, you never, unless you itemized, you never got to the tax impact of charitable giving was null. So now there's a benefit to individuals. So I think from many, many, many people, so the 90% of people or 91% who don't itemize now can get a tax benefit. I mean, obviously, hopefully people give not just for tax reasons. And I always talk about that. And clearly we see that. But isn't it nice to be able to make a gift and get a tax benefit as well? So this is a huge opportunity. I think for donors who make annual gifts every year to an organization they love, this is a really nice motivator to even maybe increase that gift because you're getting the tax deduction. So actually you're getting a financial benefit because you're reducing your tax. So if you were only giving, I don't know the numbers, and that's where I'll defer to Jonathan, but if you were giving only 500, maybe you can give 750 now because it's going to have the same impact for you as an individual, something like that. Talk to your advisor. I'm not telling you what to do, but yes.
You also get a little bit of a double benefit because the reason why when you're not an itemizer, it means you get the standard deduction, which is now I think it's 19,000 per person. I'm drawing up now. I draw a blank on that. I should have had it in front of me. But you get this nice big standard deduction, which 91% of the people take, which is a deduction from your taxes, and you get, in addition to that, you do get the
$15,750.
Actually, maybe it's similar to like when you used to put money in your IRA, you get that. It's like a nice deduction. It's above the line deduction, reduces your AGI, and AGI is kind of important. It's a little more important than the regular deduction. And well, Stacy, I have a question though related to it. Have you also realized that the giving from IRAs, which has a similar benefit? So maybe you can talk about the IRA giving.
Yeah,
some changes there, but generally I like to connect.
Yeah, those are generally the same. I love the qualified charitable distribution from an IRA as a charitable gift. You'll hear it referred to a lot as a QCD. And what this means is that donors who have IRAs, and while this starts at 70, it really becomes meaningful at 73 when you're required to take a minimum distribution, which is called the RMD. So we have the QCD and the RMD. If you take your RMD, you have to. There's a percentage that's based on the amount and your age. That is taxable income to you. If you don't need that money, what you can do, and this has been around since 2006, it became, I think, official in the pension in 2006, you can transfer that to charity. And what that means is it's actually probably the best way. You don't get a deduction. You don't need a deduction. You actually reduce your exposure to tax by that entire amount because you've given it to charity and you get to do something good with it. So it's really a way to reduce your taxes, whether or not you itemize. That's why I love this. Whether or not you itemize, whether you take standard, it doesn't matter. You're just reducing your tax exposure. It's interesting. We had an event for our Honor Society yesterday in Manhattan at the Harmony Club. And I always talk about this and people get very excited. This is really the kind of the low-hanging fruit in making a charitable plan gift, which is just taking money. You can do it this year up to $108,000. It goes up every year. It's adjusted for inflation, but you can take that amount every year and just transfer it directly to charity. Don't let it hit your bank, yourself directly to charity, and you just reduce that exposure. So it almost doesn't matter. You're like immune to all the tax changes. You just reduce it.
Yeah, I want to add that in my estate planning work, individual planning, I've found quite often people leave too much in their IRAs, and that sometimes is not a positive thing.
Right.
And for example, my mom, her only investments are her IRAs and 401k, 403bs, and my sister and I both agree that she's got too much in there, and we've been begging her for years to reduce the amount of money in those accounts, because at some point, if it complicates matters. Let's put it this way: you'd have to, if she ended up needing a nursing home, she would all that have to be spent down, and so better off if you're going to make charitable gifts. If you're particularly not an itemizer, you can use your IRA, great giving vehicle, and does avoid the RMD, does count for RMD. All good, all good.
Can I talk about the gift annuity option too?
Yeah, so I'm gonna say yes. Please tell them about this, but before I let Stacy go on this, because I know she knows this really well. This is a bit of a complicated, little different, complicated type gift, and if you think, oh well, that sounds kind of interesting to me, you can reach out to Shelley and the staff, and we can get illustrations for you on how to do this. But Stacy, you tell them
I'll guess, and you jump in, Jonathan, because I don't. First, there's a gift, something called a charitable gift annuity, and that is a great charitable gift. We do them a lot at Weitzman, where you make a gift to the charity and you get an annuity, a fixed payment in return for the rest of your life, regardless of what happens to that original principal. That's the charity's taking that on. You can, there's a bigger conversation, but you can usually the best way to do it is while you can use cash, it's great with appreciated securities, because you get the annuity based on the fair market value. So if it's a good day in the stock market, we've had some of those, it's a great way to make a gift annuity. What you can do with your qualified charitable distribution, the law has changed, I think since 2017, where you can do a one-time gift once in your life, take a piece of that IRA and make an annuity out of it. And it's basically converting, so to Jonathan's point about having too much, what a great opportunity. I know there's lobbying to make it more than once in your lifetime, by the way. I'm sort of involved in that. But at least once you could take that money sitting in your IRA and turn it into an annuity. And it's right now $54,000 one time. It goes up every year for inflation. So it's just another option to consider.
Yeah, so I have two questions related to this. First question was when is too much money in IRA? So really that question, I just answered that sort of a separate issue on a personal planning amount. I would say, and this question I was going to answer if you had asked later, but I'll answer. When people have around let's say about $500,000 of assets and less, and they're trying to do some planning and they're not sure, if this is going to help them in their I'd say you have to make a decision whether you think there could be a possibility of need to go on Medicaid, and so that's really becomes the issue. Too much in your IRAs, and one of the advantage, because I said, like, my mom, she probably left too much in her IRA, and we took the proceeds from her house and we put that in irrevocable trust, so that's completely protected. But if she needed, and we'd be fine with it. She would, if she needed the care, we would have to spend down all of her IRA funds, and if she had to go to a nursing home, they all have to be spent down. So you're kind of locking up too much, and then my mom's upset. She doesn't want to pay taxes on it, but it would have been a good idea to do it. And if she was charitable, that's a joke. She's not charitable. Her son's that's my career. She's not charitable. And I saw another question.
Yeah, a good one.
Yeah, yeah. But there was another question.
There was one about, is income from a charitable gift annuity taxable?
Yes. So you can answer that one.
I'll start it. Yes. Not all of it, though. A portion is taxable, but a lot of it is not, because it's considered a return of your own money, because you're just getting an annuity that's a principal. So it reduces it is taxable for your life. Well, actually, I said that incorrectly. It's not taxable for your life expectancy. It's not taxable. So that actually makes it more impactful. Capital gains could be, you might have to pay capital gains tax for appreciated security. So I started with that. Income tax, you avoid paying income tax for your life expectancy as calculated by IRS tables, not reality. So there is a long period of time that it won't be taxable. And the capital gain portion might be taxable if you have capital gain. A little bit will be each year, but it's a pretty modest amount.
Yeah,
Jonathan, give more details.
Yeah. So I typically, when somebody does a cash gift annuity, typically about 70% of it's not taxable during the life expectancy. So you have to pay, you're gonna pay a little tax. You get a 1099 each year, and then if you add in the capital gains, the part of the capital gains will be spread out over your life expectancy. So you still get the advantage of not losing principal. So let's say you're doing a really big one, $100,000, and it was you had stock that you paid a penny for. So you would have, if you had sold that stock, you would have lost about 20% of it in capital gains, and then you could reinvest it. If you put it into a charitable gift annuity, you would get a fixed annuity based on your life expectancy or a joint life expectancy, and then the non-charitable portion of the capital gains, basically a certain split there, we spread out over your life expectancy. So still not a bad result. So I've had people look at it and say, well, I love all that tax-free income. I said, that's fine. You can fund it with cash.
Yeah.
Or I want to avoid the capital gains. Great, you can fund it with stock. So now but we still have to talk about the IRA.
The QCD, that is taxable. Not when the payment from the QCD, the annuity is taxable because you have to pay taxes eventually.
Oh yeah, that's a separate, yeah.
Yeah, that was one of the questions here.
Yeah. So that is, you should know, the tax-free part of it goes away. You don't get a new income tax deduction, and you don't get the tax-free.
But you satisfy your RMD.
Yeah.
So.
Yeah, actually, one of the cool things, Stacy, I don't know if you've seen this done. We'll get to these questions. I've actually seen a couple people, they love the option, the $54,000 gift annuity from their IRAs. Husband and wife each can do one.
That's right.
And they can each do joint life annuities. So they both get, so it's kind of interesting, even though each has to do their own annuity, but they can choose it to be joint life. So the rate goes down. Obviously, it's a joint life expectancy, and the rate goes down a bit. But that's a nice. So one of the last one I dealt with, somebody did 100. They did the max. They did 100. It was $108,000. They were very excited about it. So it's something to keep in mind. And also, one of the nice things about, back to the topic of reducing money in your IRAs. So now you have less in your IRA, but you're getting this annuity. So you're getting, and it's guaranteed from a different source. It's guaranteed, and the pool that Workers Circle participates in has $60-70 million in annuity. So it's not a risky pool. There's a guaranteed rate, and the rates are actually very favorable. But let's take a quick look at the questions here, see if we got them all, because I don't want to run through this.
There's one for you at the end. I think we got the others. Let's see.
Okay, yeah. Yes, okay. Question. Yeah, this question comes up. I'll read it. Are the options, advantages or disadvantages different for a Roth IRA? Yes. First of all, for a Roth IRA, I mean, it'd be really nice if you want to give a Roth IRA to charity, but you don't need that. Usually Roth IRAs are for individuals. It gives you tax-free growth, tax-free withdrawals during your retirement. When you're older, you might need it, or even to your heirs will get it tax-free. You give other things to charity. So it's not really meant for Roth IRAs are not meant for charities. Stacy's agreeing with me.
Yeah, I agree, because we didn't really talk about, but IRAs are not great inherited. We didn't really go into that. They're great for spouses, but they're not great to give as an inheritance.
Well, I'll tell you that my first presentation in Planned Giving, it was in 1998. So 1998, the taxation on estates the levels were very low. So it's very good likelihood of estate tax on typical people's estates, and we had this calculation. You could lose 70% or more of your IRA in taxes at that time. It's just possibility of between income tax and estate tax. So I got up and gave a presentation in front of a board, and a lawyer in the audience immediately dismissed my comments publicly by saying, "Well, we've got the stretch IRA, So they used to, and this is no longer the case. They got rid of the stretch IRA, but lawyers used to create these complex plans of where you you would pick your younger heirs to be the beneficiaries of the IRA, and then those heirs could take it out over their life expectancy.
Right. Yeah.
And they got rid of that. Just so you know, it's a 10-year. Husband and wife can always leave each other the IRA, and you fully inherit it. But if you leave it to anybody who's 10 years or more younger than you, they have a 10-year window to withdraw the money, or if they're under 18, they have till they're 28 to withdraw the money. So that was a relatively new change. So so IRAs now are not really good for charitable giving.
But when they take it out too, don't they pay taxes? It comes
Yes, and as you take it out, you pay taxes.
Right. When you inherit other things, you don't pay taxes on it. So
well, actually, I did look up New Jersey. For this call, in New Jersey, I was looking up. New Jersey does not have an estate tax, but it has an inheritance tax.
Yes, so does Pennsylvania. So yeah.
Yes, not for children or a spouse, but get a little further distant, and there's a tax on inheritance.
Interesting. That's a good point.
Yeah, but usually you're right. Usually when you inherit things, you don't pay taxes, but the IRAs you do. And if you inherit an IRA, and you're over 18, you have 10 years to withdraw the money. You could take it all out now, but you pay all taxes on it. So so that was a good question. All right, so so are you ready to talk about the other changes to charitable giving?
Sure, I'll do the best I can.
Okay, so I agree with Stacy. I think the non-itemizer deduction is something you should all put on your radar. Keep your tax receipts. Now you should keep your receipts, so that you might get up to $2,000 in giving in a year, and you'll get a nice benefit from it. It's worth something on your tax return. The other thing they did, and this is kind of interesting, because it coming from the party in power who pushed this thing through, I was a little surprised they did this, but they basically changed some of the rules for your charitable deduction for the itemizers. Yeah. So you give it a shot at this, and
I'll start it. Yeah. So actually, some of this has been talked about. I've been teaching plan giving for 17, 18 years, and it's always been in the budget that we were so that was one of the things that they did, which they've been talking about forever. I remember Obama had it in one of his recommended budget. It never passed. Was reducing from the top, the amount that people can deduct when they itemize. So we're talking about people who don't choose the standard. They have enough deductions to itemize, which would usually mean they have a house and they have interest and things like that, or a huge charitable gift or medical expenses, but they push them into the itemized Schedule A. And there was always talk about reducing the ability for itemizers to take at the very highest tax bracket, to take that full deduction, which when you take a high deduction, it really means that the cost of giving is lower. So if you're at the 45th percent, or whatever the highest is, every dollar is only costing you 60 cents or something like that, just to kind of have an idea. They've always talked about reducing it, so you don't get the benefit of that high. You get a little bit lower, but it has not passed until, kind of ironically, to your point. I mean, it showed up this summer in the BBA or whatever. 3BA.
But they did more than that. They didn't just tax the high end, what's called
then they reduced the low end.
They reduced the starting point where you get your deductions.
Right. The first 5% you don't get to deduct either. So it's a squeeze, right? Is that
first 0.5?
0.5%. Yes. 0.5. So it's a squeeze. You don't get the full benefit. Starting in 2026, you're not getting the full benefit of the itemization. So it's
I have a numbers example. I would
because
for example, so it's based on your AGI. So let's say your AGI is perfectly $200,000, which is not too high, not too low. So multiply 0.5% by your AGI, and that tells you that's $1,000. So the first, if that was your AGI, then you don't get a deduction for your first $1,000. So I'll give you an example, which I'm going to be talking about tomorrow in a different webinar. If you decide to give $10,000, you're that person, $200,000 AGI. If you give $10,000 to charity this year, and you're an itemizer, so you get a full benefit, you get to deduct $10,000. If you give all the $10,000 in 2026, when the law kicks in, and by the non-itemized deduction kicks in next year. If you do it in 2026, you get a $9,000 deduction. You lose a $1,000 deduction. And if you do it in over five in 2026, 5 in 2027, you get an $8,000 deduction, because you lose you're losing the first 0.5%. So And then I just want to comment on the cap. So they're capped at 35%. So if you happen to be paying the 37% bracket, which you've got to have income in well excess of $500,000, good for you if that's the case. Any income that goes over that level is going to be taxed at 37%. But when you get your deduction, somehow they're going to take away 2 cents. You're not going to get, it's basically, basically, it's a very complicated calculation. I don't even try to calculate it because
That's why I
just,
let you do it. I'm not doing it.
I spend a lot of time. Basically, I say, people, if this is a challenge for you, talk to your accountant. People may actually want to what's called front load giving. So people who are really annoyed by this, people, particularly accountants who are very wealthy, I found accountants who have done very well, and this stuff bothers them. Then they could put, advance gifts to a charity, to Worker Circle, or to a donor advised fund. Have you seen any of that yet, Stacy? Just wondering.
Yeah, no, it's actually something I'm really talking about. Well, and I think as your illustration kind of points out, the impact is a little bit unclear for people. They're going to get their itemized, but they might do better. Like there may be the overall impact may be different because they're going to have the SALT tax. Things are going to change. So their overall tax impact may be different. But we are encouraging people who have pledges to, think about prepaying them. We're using it. I know that because I sit on this national board of plan givers, a lot of higher ed are really pushing donors to think about front loading their giving. Give now, because it definitely will have an impact in future years. And I don't know if it's permanent, but it's for the long term. So there's a big push. And I think donor advised funds are definitely something a lot of donors are thinking about. They can just get as much as they can into that now and then recommend it later to charities. But yeah, we are pushing it.
Yeah, so I have a question here. Does the new 0.5% exclusion, right, that's apply to QCDs? And the answer is no. Yeah. So this 0.5% only applies to those who are making itemizers and making charitable gifts. And so you won't, the first 0.5% of your AGI will not be deductible. And I have to admit that now I realize Stacy and I are probably two of 10 people in the entire country who really followed this. I'm surprised that she remembers that Obama years they were proposing this. I was upset about it. I used to blog about it, but now I'm like, oh, now they did it.
They finally did it. Yeah, I've been teaching this. I teach this class on tax and tax deductions for charitable giving for like 60 years, and I always have to update my slides. And this summer I had to really update them because there's some major changes. So that's how I'm following.
Yeah. Basically, they're taxing. Basically, what happens is when they do these huge bills, the numbers are so staggering, and they have to somehow make it come together.
Yeah, exactly.
We just grab a little from here. But in the not-for-profit world, we are not pleased with that. We think that that is not I wouldn't say chilling, but it's not a positive message for people, because the not-for-profit world does a lot in this country, and why shouldn't people get full benefit? Question here: did they change the charitable deduction cap? Was 60% of AGI? The answer is no. They actually made that permanent.
Yeah, that's a good thing. Yeah,
it's for cash giving.
Yep.
For example, if you want to say, I'm gonna take some stock or some other asset that I wasn't using anyway, I'm gonna put into a donor advised fund. So that's an advantage with donor advised fund. Again, you could park. I have a client of mine where they're putting $5 million of stock, a highly appreciated stock, zero basis stock, which is all taxable, putting $5 million per child into donor advised funds. So they're getting and then the deduction, they're not so worried about it. They'll get the deduction one way or another. But so if you decide to do something big this year, you would have the advantage that you could deduct up to 60% of your AGI. And what else you get, Stacy?
Yeah, no.
You get to carry it over if you don't use it.
Right, you carry it for 5 years. I was like,
you get an extra 5 years. So sometimes people say to me, well, I'm not going to be able to use it. I said, no,
that's great. You have 6 years of tax deductions.
Yeah. Wait, was there another question here? No open questions. Okay, let's think. Anything else before we switch to the any other topics? Do you have, well, before we switch over to some personal planning topics, which is more my issues these days, anything else you have, Stacy, for year end?
I push I guess I'll two things. So one, just a reminder, the QCD, and just to go back to that question, the benefit of a charitable distribution from your IRA is you don't get a deduction, so it doesn't show up. You just don't have to pay income tax on it. So that's why the 0.5 isn't relevant to it. So just go back to that. I push charitable gift annuities as well. I think they're a great way for donors, and they're great for year-end gifts. If you need a deduction or you have some appreciated stock, to turn that into an annuity and also make a legacy gift. It's like just a win-win. So I really push those. And
I want to add that we could, the Worker Circle, we can get them done quickly. Because the foundation, they don't issue them directly. They issue them through the National Gift Annuity Foundation, which is a very large, it's connected to a very large foundation. So they're as long as you don't wait till December 31st, you could, it could go up to even December 20th. We could probably get it done. So if it's interesting to you, just check in with Michelle and Jamie, and they can get us, we'll get you illustrations.
Good. Yeah, so that's and the big thing is not everyone gives for tax reasons. People give to give and be good. And the tax is just a part of it. It's an incentive, but there's other benefits. So yeah.
Okay, so you want any well, actually, no, I looked up this morning. I was kind of, I had looked up the I mentioned the state taxes originally. And then, so someone said, well, you even have $10 million in assets, I'm not worried about estate tax. But actually, if you're in New York, for example, I was looking at this yesterday, because I have to admit, I once was giving a speech in Borough Park, New York. It was a very Orthodox group there, and they brought me in. They're very pleasant people, and it was a very nice speech. And afterwards, somebody came over to whisper to me, like, you messed up on the, you might have been a little off on the New York State estate tax. And I was like, oh, they were so pleasant to me. They didn't want to embarrass me in public. So I wanted to check before we did today. And I realized that actually for New York State, I don't do much. I'm more of a New Jersey attorney. I have a New York bar. But I looked at New York. It's a pretty big issue, the estate tax level. It kicks in around 7.3 million, a little over 7 million. But if you're not careful, you could be pretty significant chunk could go to New York State estate taxes. So even though I mentioned that 30 million per couple, and the way they set up the law is that actually you should go to an attorney. If you're anywhere near that, you should be talking to an estate planning attorney. But the way they set up so that you can, both husband and wife get to share their, it's called portability, whatever that is. You got 30 million if you're married, 15 million if you're single. But you really do, once you get into a couple $1 million and more, for sure you do need some sophisticated planning. And and especially in New York State, could be the state level state tax could be a big issue. Or in New Jersey, the inheritance tax is there, and then other states have other things. I can't speak to other states, but well, I'll tell you, Stacy, this morning I met with a couple doing a power of attorney. So recently I got much more into things like just redoing wills for people, power of attorneys. And power of attorney is a big issue. And I found out recently I have to help somebody actually have two people now, power of attorneys with people who have dementia already have a diagnosis. And the question comes up is, can you even do a power of attorney? So I've had a case where and a power of attorney, as we know, is obviously, as you get older, you need somebody. If you haven't done more sophisticated trusts and things like that, you need to have somebody who can step in and manage your finances. And you don't want to wait till it's needed, because if you wait till it's needed, then you can't get it done. But this morning, I already had a situation where a woman had a stroke, and we could not get a power of attorney. We knew done for her, and wasn't being accepted, the old one. And then the last two situations I'm dealing with now, person has been diagnosed with dementia. So initially you might say, well, you can't do it. How are you going to do it? But actually I did a little research, and I found, the standard mental capacity standard for a power of attorney is not the same as a will. And so in one case, we're going to have a neurologist look at the standard and give their opinion. In another case, we're less worried. We'll go ahead and do the power of attorney very quickly. So these are the issues that I deal with on a regular basis. Let's see, there's a question in the chat. Oh, someone put up here, good. Washington State, thank you for this. State tax is just over 2.3 million.
Wow.
and average house is 900,000 King County. And I don't know what the rate is, but like in New York State, the rate is like 16%. And actually, what I saw this morning was if you don't do it right, you'll get hit with a full 16% of the full $7-8 million. If you don't do any of the planning, it immediately it'll actually hit the whole amount. So 16% of $8 million actually is pretty significant. That's a pretty low level for state tax to kick in. But again, the rate's usually state level is between 5 and 15%. My guess, I'd have to look it up.
That's interesting.
Any other questions from the crowd? Because we meant to talk for 45 minutes, and we're at 45 minutes, but we had a lot of questions. Stacey, you have any questions?
I'm going to ask you, Jonathan, a question. I'm curious, just from your experience, because I see things from a different perspective, working in a nonprofit. How often do you see people just from all walks of life setting up trusts, and what kinds of trusts do they set up?
Yeah, so very good question. So there are a couple of main types of trusts. So let's start at the high end. So the high end are trusts that are people using essentially to avoid estate and gift taxes. I've been involved in one family where we've set up over $500 million in trusts that have successfully moved into what's called irrevocable trusts, and that's for the kids, and they've already what's called beyond the estate tax and gift tax. So that's probably not for this audience, but if that's what they usually do. But typical people, there's two types of trusts that we deal with. A revocable living trust, which is a very nice way to sort of set your estate up. It's not about avoiding estate taxes and gift taxes. It's more about management of your assets in a very efficient way, avoids probate. And I have to admit, after my opinions are changing on certain topics in estate planning. I've come to the conclusion that people should really avoid probate. They should take every step to avoid probate, because the more and more probate just means sounds simple. Oh, you go to the court and they issue these papers and you change title. But more and more probate has become just time. It takes years and hassles, and nobody really, an estate that I wrote the will for, and then I was consulted with the executrix on her father's estate. I asked her, just saw her this weekend. I asked her, was it ever finished? Well, it's not really closed. It's been over 10 years. And I said, oh my gosh, these things never close. So the revocable living trust, it's not a requirement. It's not something you better get one. But if you're concerned about, you don't want to see your heirs struggling to deal with your assets after you've passed away, or even when you're disabled, it's a lot easier. It's like a super duper power of attorney, and it's also in lieu of your will. Now, of course, you would still need a will if you have a revocable living trust. And of course, your revocable living trust, it's you. It's just your social security number. You get the same tax benefits. Now, the other type of trust that I do deal with, which is back to what we mentioned earlier, is what if there is a concern of what if you end up in a nursing home and you just don't have the assets, and you think at that point you'd really want to be on Medicaid. So it's called like a Medicaid asset protection trust. Basically, that's called an irrevocable trust. So I'll just tell you what I did with my mom. So my mom, she's 86. She should live me well. I don't think this will be relevant to her, but we did it anyway. We did this for our grandparents also. She sold to her. The only investment she has beyond maybe my grandma left her some stock, PSE&G, whatever here and there, not a lot there. She has her IRAs and her 401ks, but then the house. My parents bought a house in Parsippany in 1968 for $30,000, and she sold it 6 years ago for $500-something thousand. So that $500,000, what I said, do not put that in her name. I created a trust. My sister and I are trustees. It's an irrevocable trust. I did not put her as a beneficiary of the trust, but I wrote it in a way that obviously we're going to use it for her benefit, but that's off the paper. And 5 years have already passed. That's what's called the look back period. Most people are familiar with that if she had needed to go into a nursing home and needed Medicaid to help with the nursing home, they would look at all transactions within 5 years. So now we're beyond the 5 year period. And again, the money's just there for her. We hold on, we invest it. It's there for her benefit. So that it comes down to, do you think you have enough assets if you needed to spend some time, if there's to meet a long-term care or in a nursing home, or there would need to be a spend down? Then you think about the irrevocable trust. But I don't push people. I think people, it's a tough challenge, tough question that comes up, and I usually give people discuss the options, and sometimes it's usually pretty obvious which way they should go. And I try to guide people. Yes, here's a question here.
Yeah, that's a good
Um,
one.
compare tax considerations of gift directly from IRA versus gift of appreciated stock in non-IRA account. So the tax considerations are, I mean, if you go from the IRA, you're avoiding tax on the IRA money, on that money. So you don't get a new deduction, but you're avoiding taxes, which is basically the same as a deduction. If you actually want that deduction in your tax return and you have appreciated stock that's in a non-IRA account, then you can get the benefits. It's really your preference. If you've got the asset in a non-IRA, it's appreciated stock, you can go ahead and create that gift annuity, and you get a really nice triple benefit. You avoid the capital gains, get an income tax deduction, partial income tax deduction, not 100%, and you might get a little tax free, you might not. Or if you say, you know what, it's more comfortable coming from my IRA, directly from IRA. Both of them have nice benefits on both sides. So, yeah, you'd have to actually answer the question right. I have to do an Excel spreadsheet and a little chart and line by line and try to compare them side by side. And I think at the end of the day, if you care about charity, you just pick what's most convenient for you. I wouldn't,
What I would say to that, I think it's a good question, is it actually illustrates to me. I mean, you're not going to see this because you're the advisor, but for me, if I got this question from a donor, I'd say this is the perfect question to ask your advisor who knows your financial assets. And it would end up being they would do the calculations. What do you have more of? What is the, how much appreciation is there? What's the cost? Do you really want to donate that? How much do you have in your IRA? Maybe it's some combination of both. And that's really where your advisor comes in and looks at what you have and crunches the numbers, kind of like Jonathan suggested.
Yeah, I agree. Yeah, I agree. Or you could even do both.
Yeah, you could do a little
You
bit
could,
both.
there's no stopping. And one of the, I just want to add, the IRAs, I have other charts from other presentations about IRAs. Typical people, that's where the majority of their financial assets are. I'm not talking about the house, but like my mom is a perfect example. 100% of her financial, 99% of her financial assets were in her IRAs and trusts. And that was and she didn't even get her career going until she was like around 50. But she was very diligent in putting aside whatever they matched at her jobs, and it grew, and they did a great job investing. IRAs are great you could do for direct giving. You could possibly do a gift annuity, and you can even do a legacy gift. I just want to throw in the pitch there. You could even name a charity along with individuals to receive some of the funds. And obviously, charity when they receive it as it's not taxable to the charity.
Two questions in the Q&A, and I see two questions in the Q&A.
Yes. So, Q&A. Let's switch to the Q&A. Okay. Is it possible with the Medicaid irrevocable trust to take out income as needed for the person whose trust it is? So I just answered this question for my mother-in-law. So I told her she doesn't have a lot of assets. We need to just get everything out into an irrevocable trust. And she said, well, I want the income. And I actually spoke to a more experienced elder. I'm more of an estate planning attorney. I haven't specialized in elder planning. So I dabble in it, but I don't, so, and the answer is not directly. If you do a Medicaid irrevocable trust, you really should not be taking the income directly. And that was really from a good source. I kind of knew that already. I did that with my mom. So my mom is not a beneficiary of her trust. I called it the Madeline Gudema irrevocable trust, something like that. So it's clear that's her. It's for her. I mean, my sister, brother, and I, we're not using the money except for her. And so for my mother-in-law, I told her what we'll do is her sister will be a co-trustee with me, and we'll send the income to her sister who has a joint account with her, who can move it to the joint account. So that was not a good idea to have any direct income from your Medicaid irrevocable trust directly to you, because that could cause trouble with your with Medicaid. The Medicaid will look at, no, where are you getting that income from? So if it's coming from an individual, that's not a problem. But if it's coming from this quote Medicaid trust, not a good idea. Next question. Do you have any recommendations of criteria to consider when choosing an executive will? Well, obviously, executive will is somebody you have to trust that will
I'm just gonna
follow.
say, to me, it's trust.
Yeah,
Yeah,
trust. The
and
best-
younger than you,
What's that?
and young, as young, yeah.
Yeah, young enough and somebody who you trust and somebody who's capable of following through. It's a lot of paperwork. And this would be more for the push. My push is if you could do some planning, you could do a lot of different things to really empty your estate. And I do deal with people quite often, which they really have. They're going to be no estate. There's going to be the person I was dealing with this morning, who we're doing this power of attorney for. I asked them about their assets. I said, "What does she have?" She doesn't have a lot. There'll be no will to be probated.
Yeah, sounds about it.
Yeah, so it really depends. Here's a question here. This is an interesting question, chat. Yeah, from the chat, I want to read this question here. I'm age 68. Can there be an advantage to give to a donor advised fund this year the estimated amount of the annual charitable giving that I plan to make until yeah, that's a great idea.
Good idea. Yeah.
Until 73.5, and then they use the IRA. That is from two charitable lawyers. We're like, yeah, great idea.
I mean, from a charity's perspective, they might say, well, if you're going to give it to us anyway,
okay,
why put it in a DAF? Just give it to us. We'll use it over 5 years. That's
yeah, but
what a charity might say.
Yeah, so let's say interchangeable. Either way, it's a great idea. Whether it's going directly to charity now, and I have this, or wait, and then waiting to 73.5, and then using your IRA. It's a really good plan. I actually had somebody ask me this question. I just had this question asked to a group of fundraisers. They said, "Well, is it legal? Let's say somebody has a multi-year pledge and they decide to pay it all up now." I said, "That's not a problem. You give them credit for the next couple of years. You're going to get a deduction this year, and it's just internal reporting." And
Yeah, exactly.
yeah, that's not a real question, but it does come up. So you can always do it, and you can tell. Let's say you want to give worker circles a couple of years of gifts. Trust me, they'll be very happy. And you just say, "Listen, I'm going to give you 30,000, but I really meant to give you 10,000 a year for the next 3 years." They can credit you, and I think that we can work it. They can work it out.
And think of the impact when you.
Yeah, no,
you know,
yeah, it's
very impactful.
yeah. I think people will be. I hope maybe anybody on this call has any, get something. Let the worker circle people know. Hey, this was some good ideas, and maybe they use them, because this is between now. It's really almost November. Fundraisers who do what's called major gift fundraising are taking my classes, and I'm telling them, I'm suggesting to call individuals and just put this idea out in front of them. Maybe they want to do a little more giving now, up front load before the end of the year, because the tax benefits for charitable giving might not come back fully for some time, if ever. You never really know. So people who, particularly bigger gifts, when I gave the $10,000 example, well, then you can multiply it by 10. Somebody giving $100,000, they're losing a pretty significant chunk of that, losing 10,000 of it right off the top, even more because if their AGI is higher. Okay, I think we got all the questions then.
Yeah, I think so.
Okay, any final comments from the crowd? I hope this was helpful. This is the first time we did this conversation thing, and I think Stacy did great. I don't know.
Oh, thank you. It was fun, and it's a good cause, and I appreciate the opportunity. So nice to meet you all, and thanks, Jonathan.
All right, I think we're finished, everybody. We hit the hour. Shelley?
Yeah.
Yes. Thank you. Thank you for this important information. We recorded the program, so we'll be sending this to you, and please feel free to share this with your family and your friends. We hope you enjoyed the program. Usually we offer these webinars twice a year, a mid and a year-end estate and retirement check-in. If you have a topic that you'd like us to cover in particular, please let us know. And if you have any questions about our webinar or about the Worker Circle's current programs or plan giving options, please contact us at info@circle.org. Thank you, Stacy, Jonathan, and Leah, for managing the technology. And thank you all for joining us at our webinar. We look forward to seeing you again at our next program in 2026. Thank you.